What if I told you that missing just the 10 best days in the stock market over 20 years could cut your returns in half? Today, we're diving into one of the most important investing principles that could make or break your financial future: why time in the market beats timing the market. Hey everyone, if you've ever found yourself frantically checking stock prices, wondering if you should buy the dip or sell before a crash, this video is for you. I'm going to show you why your obsession with perfect timing might actually be sabotaging your wealth building journey. Let's start with a story that might sound familiar. Meet Sarah. In 2020, when COVID hit and markets crashed, Sarah panicked and sold everything. She waited on the sidelines for the perfect moment to get back in. Meanwhile, her friend Mike stayed invested through the chaos. Fast forward to today, and Mike's portfolio has significantly outperformed Sarah's, despite her attempts to time the market perfectly. This isn't luck, it's math. Market timing sounds logical in theory: buy low, sell high, wait for crashes, then swoop in. But here's the brutal reality. Even professional fund managers, with teams of analysts and supercomputers, struggle to consistently time the market. Studies show that over 80% of actively managed funds fail to beat the market over 15-year periods. The power of time in the market. So what does time in the market actually mean? It's simple: staying invested for the long haul, regardless of short-term market volatility. Here's why this approach is so powerful. Compound growth works magic. When you stay invested, your returns earn returns. Albert Einstein allegedly called compound interest the eighth wonder of the world, and for good reason. A $10,000 investment growing at 7% annually becomes $76,000 in 30 years. But if you miss just 1 year of that growth due to bad timing, you lose thousands. Missing the best days is costly. Here's a mind-blowing statistic. From 1980 to 2020, if you missed just the 10 best days in the S&P 500, your annual return dropped from 11.8% to 8.1%. Miss the best 20 days? You're down to 5.6%. The problem? These best days often come right after the worst days, when fear is highest and most people are selling. Dollar cost averaging advantage. When you consistently invest over time, you naturally buy more shares when prices are low and fewer when prices are high. This dollar cost averaging smooths out volatility and can actually improve your average purchase price without any market timing skills required. The psychology problem. Even if timing were theoretically possible, we have a human psychology problem. Our brains are wired for survival, not investing success. We feel losses twice as strongly as gains, a phenomenon called loss aversion. This leads to emotional decisions: panic selling during crashes and FOMO buying during peaks. Fear and greed are the enemies of good investing. When everyone is fearful, that's often the best time to buy. When everyone is greedy, that's often the best time to be cautious. But our emotions push us to do the opposite. Real-world evidence. Let's look at some concrete examples. During the 2008 financial crisis, many investors sold near the bottom and missed the recovery. Those who stayed invested and continued adding to their portfolios during the downturn saw massive gains in the following years. The COVID-19 crash of March 2020 is another perfect example. Markets fell 30% in weeks, but recovered to new highs within months. Investors who tried to time the bottom often missed the rapid recovery entirely. Studies consistently show that the average investor underperforms the market by 2 to 3% annually, largely due to poor timing decisions. Meanwhile, investors who simply bought and held index funds over the same periods achieved market returns. Practical implementation. So how do you put this into practice? Here's your action plan. Start early and stay consistent. Begin investing as soon as possible, even with small amounts. Set up automatic investments to remove emotion from the equation. Embrace market volatility. Don't view market downturns as disasters. See them as opportunities to buy quality investments at discount prices. Focus on time horizon. If you're investing for retirement 20+ years away, daily market movements are just noise. Focus on the long-term trend, which has historically been upward. Diversify and rebalance. Spread your investments across different asset classes and rebalance periodically to maintain your target allocation. Conclusion. Remember, in investing, time is your greatest ally. The magic happens not when you perfectly time the market, but when you give your investments time to grow. Every day you wait for the perfect moment is a day you're missing out on potential compound growth. The best time to plant a tree was 20 years ago. The second best time is today. The same principle applies to investing. Stop trying to time the market and start giving time to the market. If this video helped shift your perspective on investing, hit that like button and subscribe for more financial wisdom. What's your biggest challenge with staying invested long term? Let me know in the comments below. Remember, time in the market beats timing the market every single time.